If you're wondering whether it's a good time to load up on US stocks, or maybe proceed with a little caution, then perhaps the Buffett Indicator might be of use. If you've done even a modicum of research into investing, then it won't take you long to work out who invented it. Legendary investor Warren Buffett proposed it in 2001 and called it probably the best single measure of where valuations stand at any given moment. It's a simple-ish calculation, and it's the ratio of the stock market value to GDP. Thankfully, there are a few sites which do this calculation for us. Currentmarketvaluation.com is one of these sites, and there's loads of info on the indicator on the site too. Buffett also said in his essay, "For me, the message of this chart is this: if the percentage relationship falls to the 70% or 80% area, buying stocks is likely to work very well for you. If the ratio approaches 200%, as it did in 1999 and a part of 2000, you're playing with fire." So the big question is, where do we currently sit? Well, bearing in mind the S&P 500 is around all-time highs, you might have guessed the Buffett Indicator agrees that the US stock market is overvalued. And not just slightly, by quite a way. This chart is a little dated, but we're still roughly in the same position now. Not to deter anyone, remember that no indicator is foolproof. Even Buffett himself says that. And there are often bargains to be found, but they could be well hidden in such a market climate. Or perhaps we could apply this metric to other countries for bargains. I'll leave that for another day.